Welcome, everyone. We are so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management to address proactive tax strategies you can consider before the end of 2020. This presentation is a complement to JFL's September newsletter, which you should have received last week. Please visit the JFL website to download a copy of this presentation for your reference. Without further ado, let's introduce today's panelist. Jerry Lynch is a certified financial planner and founder of JFL Total Wealth Management. He has been a financial advisor for 23 years and has been working in the financial industry for more than 30.
Thank you, Gretchen. Again, I want to welcome everybody today. I have a coach for taxes, and one of the things he says is that investments are a matter of opinion, taxes are a matter of fact. Within the next couple of months, there are things that we can do to be proactive with your tax strategies, and then we could take advantage of some of the things that are available to us today. Once January 1st happens, we're incredibly limited in terms of what our options are, and I want to make sure we take advantage of everything that's available to you. Now, first of all, Gretchen did reference this. We just sent out our tax newsletter. I would say everybody, if you read one newsletter a year, this is the one you want to read, because January 1st, there is very little that we can do. So we're going to take a look at year-end tax planning strategies and some ideas that you may want to consider between now and the end of the year that will have an impact on your tax situation for this year. One of the things also that's going to happen is that this is available electronically. So if you want to send this out to your kids, if you got a next door neighbor that you think would benefit from having this information, please feel free to send it whoever you think would benefit from it. Now, this has been a crazy year. And the most important thing that I think we have to do is just kind of remember we're still here. And I want to make sure that you're staying safe and that you have your JFL masks. And you're wearing them anytime you're going out into the public. I want to make sure that you stay safe and that you stay healthy. It's really important. And now, again, when we plan, one of the things that we're doing is we're really taking a look at 5 different areas of financial planning. We're taking a look at preserving your assets. That's basically making sure that people can't take your stuff. That might include car insurance, home insurance, umbrella policies, life insurance, long-term care insurance, disability, all those things that make sure that your stuff remains yours. We do retirement planning. For those of you that are already retired, we make sure you could stay retired. And for those of you that are working right now, we want to make sure that in the future you can retire on your own means and make sure that you feel comfortable with what your financial future is going to look at. We take a look at investments. We also take a look at tax planning. And finally, we take a look at estate planning. Now, this is definitely going to be a very funky year just with everything that's happening out there. And there have been some significant changes in tax laws that I want to bring up. And it's also possible there may be some changes going into next year. But we're going to talk about a lot of different things. So the first thing that happened this year is something called the Secure Act. A couple of major changes they had there. One of which is that the required minimum distribution was pushed from 70.5 to 72, which I think is terrific. But more importantly, it impacted how beneficiaries receive IRA assets. So that's kind of a big thing, and we'll spend some time talking about that a little bit later. The CARES Act was dealing with COVID, and there was a couple of things it did, one of which is allows you to take money out of an IRA and potentially not pay it back and not have and you could do it over 3 years in terms of the taxes. And finally, we have an election that's coming up. And that election, as you all know, is going to potentially be pretty volatile. So there's a lot of things that could potentially change between now and the end of the year or going into next year. I want to see what can we do today to take a look at what we can have a positive impact on. But I also want to make sure that you're aware of the things that potentially can happen, because we may have a conversation with you saying you may want to consider these things for next year. Now, one of the questions people always say to me, what's the difference between tax planning and tax preparation? Well, basically, tax planning is proactive. It's done during the year to have an impact on your tax returns this year. Tax preparation is really kind of filling out the scorecard at the end of the game. All right, the numbers are already there. You're just putting the numbers in the right boxes. What we're trying to do is see what we could have an impact on now that will make your tax return a little bit better. And in the words of Ben Franklin, by failing to prepare, you are preparing to fail. And my only thing is, many of you pay a very large amount of money in state and federal income tax. My goal is not to do anything that's going to put you in trouble, but basically take advantage of every situation we can so you pay the least amount of money in taxes that you possibly can. Now, anytime I talk about taxes, I'm going to refer to tax bracket management. And here are the tax brackets under the current system. And I'm just going to use married because I think it's easy. So basically what that tells me is that if my income was $19,750, that income would get taxed at 10%. The income above $19,750 up to $80,000 gets taxed at 12%. All right, when I hit the next bracket, it doesn't mean all my money gets taxed at that bracket. Only the money in that bracket is going to get taxed at that rate. The next bracket is 22%, so that goes from 80 to 171, then 24, 32, 35, and so forth. Anytime I'm looking at saving money, if there's strategies that we can come back with, depending on where your tax bracket is, what's the top tax bracket, you'll get that percentage back to you. So if you're in a 35% tax bracket and we find a way to save 10,000 bucks, $3,500 comes back into your pocket. I want to make sure that we're aware of this. If we're doing Roth conversions, I want to make sure that I'm staying within reasonable tax brackets and I'm not bumping you up into a higher tax bracket that you wouldn't be retiring in. I'm always going to start here and then I'm going to work into the future. The other thing is that when I'm looking at these tax brackets, it's important to understand that these tax brackets are going to change. So if nothing happens because of something called the Byrd Amendment in 2026, the old tax brackets come back. So it means that in certain areas, my tax brackets are lower than they were prior to the change in the tax laws from Trump. 2026, automatically, they're going to be substantially higher. And another thing that I think is very important is that often what politicians will do is they'll keep the brackets the same, but they'll change how big those brackets are. So it captures a higher percentage of income at a much lower number. And I think it's very important that you understand how these things work. So if I'm looking at things today and I understand these numbers, it may make sense for me to do certain things now, because in the future, the rates could potentially be higher, assuming nothing changes. Now, two different options here. You could either have a standard deduction or you could have an itemized deduction. So under the new tax program, the standard deduction for a family is $24,800. And in simplest terms, what that means is if I have $24,800 of income, my taxable income is effectively zero. It is a deduction without any itemization. I don't need to have mortgage interest or anything. I automatically qualify for that. If I'm single, I get $12,400. If my itemized deductions are greater, so my mortgage deduction, my property taxes, my charitable contributions, my medical expenses are greater than this amount, then I itemize my deductions. Because this was increased from the previous level, many of you are no longer itemizing your deductions, which again is a good thing or a bad thing, depending on how you look at it. So again, we're always going to take a look at it. And under the old rules, basically what you always wanted to try to do is accelerate your deductions. Again, it made sense. Under the new rule, what we want to do is we want to time these deductions and making sure that they're happening at the appropriate time. What's the benefit of doing it? How do I offset certain things? Does this make sense based on everything that I have in my situation today? Now, again, part of the deduction limits that we were talking about is you need to understand state and local property taxes. So you are limited right now to $10,000 in state and local property taxes. And on your home, you're actually limited to $7,500 of mortgage interest. Okay, that's assuming you're setting up your mortgage today. So if I have a mortgage that's $1 million, it means that 250 of that is not tax deductable. State and local property taxes, I'm limited to $10,000. Because of that, it means, again, often we're not getting the ability to deduct or itemize our taxes in the future. Now, if you are charitably inclined, this creates a little bit of a situation. So let's just assume, for argument's sake, that I have $10,000 in state and local property taxes. Most of you are at that level because you're substantially higher than that just in property tax alone. I have a $5,000 mortgage contribution, which is nothing too great, and I'm giving $10,000 a year to charity. So in essence, I have $25,000 of charitable, of itemized deductions every year. Well, the standard deduction is $24,800, so I'm really only getting about $200 of benefit on my charitable contribution, and in my tax bracket, the savings is very limited. So if I'm doing that on a given for a couple of years, basically I've given $30,000 worth of tax deductible contributions, but I'm only getting maybe $1,000 back in terms of the benefit to me personally. What I could do is I could bunch those deductions. Instead of doing $10,000 a year every year, I could do $30,000 today and basically get a $30,000 tax deduction today. The difference in tax savings in that situation is about $7,200. Now, you could do one of two things with that money. You could take your family and you could go on vacation and you could have an awesome time, and basically knowing that the IRS has paid for you to sit on a beach and relax and have some fun. That's awesome. Or you could give more money to charity. Either way, it's a better way to do it. We're using the tax situation to basically, what is the best way for you to do this? Now, again, what you might be saying is that, well, if I give $30,000 to charity today, it's reasonable. I'm going to have to give more money next year, or they're going to basically think I'm not really a nice person. Well, what we can do is something called a donor advised fund. Now, two benefits here. I could use appreciated securities to give to the donor advised fund. So I could take those stocks that I've had for a very long period of time. I could donate those stocks to a donor advised fund. I get a full tax deduction on the value of the stocks or mutual funds on the date that they go into the charitable trust. And by doing this, I'm eliminating any capital gains tax that I have to pay for the federal government and for the state of New Jersey. The second thing is they go into the trust, and then basically I could have that money coming out to different types of charitable organizations over the next several years. So I'm not forced to increase my charitable contributions to any organization. For the most part, as long as they are 501c, not-for-profit organizations, I can send the money directly from that charitable trust and just call them up and say, send $1,000 to the Make-A-Wish Foundation, send $1,000 to my church, send $1,000 to the Y, whatever I'm giving money to, I could do through the charitable program. And what it does is, again, it allows me to get a better deduction today. In this situation, I'm getting a lot more tax savings than if I'm doing it individually. I'm not forced to increase the amount of contributions that I'm doing to the charitable organizations that I want to support. It's just a better way to do it. And again, we could help you with these different types of strategies. The other thing that happened with the CARES Act is it gives a new charitable contribution if you are not itemizing your deduction. So if you're single, you could give a check for up to $300. If your family, $600, at what's known as an above the line deduction. It means that you could use this if you're not using a standard deduction, or if you are using a standard deduction, still get a credit for the charitable contribution that you're doing. So again, something you may want to think about. Another thing that I highly recommend for any of you who are over the age of 70 and a half is that we have set you up with a checking account for your IRA. All right. If you're using a standard deduction, which many of you are, because you don't have a mortgage, you just have $10,000 in state and local property taxes, there's too big of a gap for you to basically be able to hit that the itemized deduction. Your RMD go directly to a charitable organization and you don't receive it as taxable income. They're allowed, if you're over 70 and a half, you could have those money goes directly to the charitable organization. You're not putting it into your bank first and sending it over to the Make-A-Wish Foundation. It goes directly to the Make-A-Wish Foundation. And by having it set up in your checking account, the only thing you need to do at the end of the year is give a list of all those donations to your CPA, and they will back that out of your income. Many retirement savers like doing it like this because if you don't need the money and you're using a standard deduction, this is a way that I could basically make it tax deductible. I'm paying them with pre-tax dollars, which is the best possible situation. So the minimum age is 70 and a half. You could do up to $100,000 a year, and the IRA has to go directly to the charitable organization. So if you have questions on that, please let me know. Okay, now we're going to talk a little bit about capital gains and lost harvesting. So we're going to look at a couple different things. Now, first of all, you need to understand what are the tax brackets for capital gains. Capital gains rates, which is something that you had a stock in the market or a bond in the market for over a year. If you had it in the market for over a year and it's not in an IRA, your tax rates are either 0, 15%, or 20%. This is a lot lower than the normal tax rates. They're trying to give you a reason to stay invested with your money. So if your tax bracket is 0, and that goes up to about $80,000 a single, one of the things you may want to consider between now and the end of the year is if your income is $70,000 for the year, okay, and we have stock gains, we may want to take $10,000 of stock gains and buy them back again in the near future. And the reason why we may want to do that is because we would pay 0% in tax. Anytime I could get 0, I want to take advantage of that. I know what the rates are now. I don't know what they're going to be in the future. The next tax bracket goes from 80,000 up to 496. That's 15%. Okay, and the bracket over that is 20. Now, what I don't want to do is take on large gains that bump me up in terms of a 15 to 20% increase in the rate. I want to make sure I'm aware of what these numbers are. So if we're selling out of securities, I want to make sure that we are very cognizant of what those rates are and how it's going to impact us. And then equally important is if we have losses in our portfolio. And if you take a look at this year, if you have things that are tied into technology, they probably did pretty well. If they have Amazon, Google, Tesla, all these, Apple, those are companies that have done very, very well. If we have those things that have gains in them, there might be some areas that have losses in them that are very good areas as well too. We could sell those losses to offset those gains. And I think that's very important, especially in the state of New Jersey, is New Jersey does not allow you to carry forward losses. So on the federal side, if I have a loss, and let's just say I lose $10,000 of income this year, what'll happen is they'll allow me, if I don't have anything to offset that, they'll allow me to take $3,000 a year against my income until I run out of that. So that would take me 3+ years and then I'm done. New Jersey does not allow that. So if I have a loss in New Jersey, I need to make sure I have a gain that I offset, because if I don't use it in the year that I have it, it basically goes away. So I could use that to reduce or eliminate any gains I have by finding whatever lost money in a portfolio. And that's something we do on an annual basis. We take a look at everybody's portfolio in their taxable account. Where do we have gains? Where do we have losses? Is there something that we could do to make this as neutral as possible? Now, again, it's also important to know there's a benefit in not having to pay taxes today. So that tax deferral, the fact that we don't have to pay taxes now is powerful. So we need to see, does it make sense? And that really gets back to the timing of deductions. Do we want to take this now? Do we want to take this later? And have a good conversation dealing with that. Now, again, when you harvest losses, it's just looking at a portfolio on an annual basis and saying, what didn't make money? Now, again, I think it's important to say too, just because something lost money doesn't mean it's bad. Sometimes there are good investments that are in a bad place at the wrong time, and because of that, they're going to go down in value. Doesn't mean there's anything physically wrong with that stock or that mutual fund. If we can sell it though, and I could use that situation, that temporary situation, to our advantage, there's a benefit of doing that. And I could sell it, and I could use it to offset the gains that we have. And in theory, I could buy it back within a very short period of time. I could use up to $3,000 of losses to offset my ordinary income. Now, again, important rule, loss sales. I can't sell something at a loss and buy it back within 30 days. That's considered a wash sale, and it's as if though the sale did not count. I need to sell out of something, stay out of it for 30 days, and then get back into it after that if I really want to continue with that fund. Again, there's also harvesting gains. Now, I mentioned before, again, what the different rates are. It seems like, again, if I have a gain, it might make sense for me to take advantage of it. Again, I want to time this thing out. I want to make sure I understand it. What it does is that I basically have to pay a tax today, but that tax rate may be lower than what it might be in the future. I need to take a look at all these different options. Remember that even if the tax is paid at a lower rate, it's paid. And again, we got to see, does this make sense at this moment in time? But again, if we have gains, we should be taking a look at those. Does it make sense to do anything at this time? Can I offset them? Can I use some losses in a portfolio to basically make this thing as neutral as possible and try to have a proactive strategy? Now, also, low-hanging fruit. The easiest way to reduce your taxes is to basically put money into a retirement account. So if you're not maximizing your 401k at work, you should. If you don't have a 401k at work, you could do an IRA. But here are the limits. So if you're in an IRA, you could do $6,000. If you're over the age of 50, you could do another $1,000 more. If you're in a 401k, you could do $19,500. If you're over the age of 50, you could do another $6,500. So you could set aside a decent amount. And for many of you, if you're in a high tax bracket, you're almost getting a 50% benefit just from doing the tax deferral. I think it makes a lot of sense to at least consider maximizing your contributions for this year. Now, Roth conversions. I am a big fan of Roth IRAs and Roth 401k plans. I think that, when I talk to my kids, I'm concerned that they're going to get stuck with a huge tax bill in the future. You can't spend at this level and not expect it to not have to get paid. So the advantage of a Roth IRA is it lowers my taxable income in the future. I don't get a tax deduction, and I could do conversions, so I have to pay the taxes today, But my analogy of this stuff is like buying out your business partner. If you think your business is going to be successful and it's going to grow a lot over into the future, you don't want to partner. You want to write them a check. You want to tell them to go away. And from then on, all of that money and that growth is 100% yours. So that money grows tax-free as opposed to tax deferred. And that's a big difference. It means that when you pull it out in the future, if you have to pull it out, it's basically tax-free. You don't have to do required minimum distributions on it. So the biggest thing when I talk to retirees that are financially successful, one of the things they always ask me is, why do I have to take this money out? I don't need it. Well, basically the government wants their money. If I don't have to do RMDs, it allows me to invest a little bit more aggressively because I'm not forced to take out distributions every year. And then the beneficiaries, if they receive this in the future, will receive this income tax free as well too. So, one of the things I tell the people when I'm doing planning, I don't care about your beneficiaries. I'm not doing planning for you so that your beneficiaries receive money tax free. What I do is I want to take a look at your situation. And again, I showed you some of those tax rates before. Some of the rates are sunsetting over the next few years. So potentially, if everything remains the same, your rates may be higher in the future. If we could do a Roth conversion today and there is no negative impact to you, even if the rates remain the same for life, again, if you pay it at 24% now or in the future, you pay 24%, no harm, no foul. If it could benefit you and it provides a benefit for your potential beneficiaries in the future, then that's something I want to consider. But the planning that we're doing is mainly about what's the best use of money for you. Now, again, when we are thinking about this, I want to know one thing. What is your tax bracket? What is their tax bracket? So for example, if you're in a 39.6 or 37% tax bracket and your beneficiary is in a 22% tax bracket, give them a regular IRA. It works out terrific for them. You would have been paying 37%. They'd be paying 22%, and it actually works out relatively well. If you're in a 22% tax bracket and they're in a much higher tax bracket, it may make sense to consider doing these Roth conversions. Again, I don't want to do the planning for them, but I do want to have it as part of the conversation. How does this impact you? How does this benefit you? How does it impact your heirs in the future? But there's some very nice planning opportunities that we have here, and we want to make sure we're taking advantage of them. All right. Now, considering qualified tuition plans. So under the IRS rules, you could give up to 5 years of contributions to a 529 plan. So that's $15,000 a year times 5 is $75,000 that I could give to a grandchild for a 529 plan. If I'm married, I could double that. I could give $150,000 in 1 year. It's actually pretty good. The other things that I could do is I could give money directly to a medical institution. So for example, if somebody is going for medical treatments and I want to pay that, if I pay directly to the hospital, the medical facility, it doesn't count towards the $15,000. The other thing that I could potentially do is write a check directly to the college. So if I have a grandchild who's going to Rutgers and I want to write a check so that his parents don't have to pay that, I could have that money go directly to that, and I'm not subject to the $15,000 gift tax limitation. So this is also a very nice planning opportunity for you. Now, right now, the estate tax federally is set up a little bit above $11.5 million times 2 if you're married. So between two of you, you have $23 million before you have an estate tax problem. Again, I always thought that estate planning is more about control of your assets and protecting your assets for your family. But from a tax standpoint, if you're worth less than $23 million, you really don't have a tax problem. Under the rules that came back, I mentioned before the Byrd Amendment, which basically says that you can only do tax laws for a certain period of time unless you get a certain percentage of Congress. In 2026, the old rules come back, and that basically means that the $11 million will be cut in half to about $5.5 million. It's also very reasonable that may be reduced. Above that level, you have a 40% tax on any assets that are potentially going to your heirs. My point is that this is a moving target, and while you may not have an estate tax problem now, you may in the future. I do think $11.5 million is pretty high, a little excessive. I think $5.5 million for most people is pretty high, might be considered a little excessive. So it's reasonable it may come down to a lower point in the future. My point is give your plan some flexibility that if these things change in the future, that all of a sudden you have no options. And I think we should be incorporating some strategies in our planning today that gives us a good opportunity for tomorrow. Now, not political, Got to say that. It's possible there may be a change in control in Washington. And to do this, you need three different things to happen. You need the White House to change, you need the Senate to change, and you need the House of Representatives to basically stay the same way. If all three of those are with one party, it's reasonable there may be a change. And if Biden gets elected and all three of those things happen, there is the ability for certain things to happen. And we're actually going to do a presentation on this specific with his tax plan in the next 2 or 3 weeks, because I think it's very important. If this happens, we have between now and the end of the year where we actually know what the rates are. It's very reasonable. If this happens, next year there'll be changes, and those changes may not be positive for certain people like yourselves that are very financially successful. So a couple of things. We're talking about increasing the capital gain rate from where it is right now up to 28%. Right now, I think it's 21%. Increase the marginal tax rates on top earners from 37 to 39.6. Potentially increasing the capital gain rate to ordinary income tax rates above $1 million. There is the ability for limiting itemized deductions to 28%. So that means if you're doing charitable contributions and you're in a high tax bracket, and instead of getting your 39.6% deduction on that money, you may be limited to 28%. You also may be limited to 28% on your mortgage interest. You may be limited to certain different things like that. So that could be a negative thing. Potentially phase out of business deductions, 199A, on incomes above $400,000. The elimination of the step up in basis. So again, if I were to die today and I had a stock that I bought at $10 a share and now it's worth 100, my heirs would get that stock with a cost of 100. So if they sold it the next day, they pay no income tax on this. There's one of two proposals out there, one of which would make it the tax has to be paid at my death. Or the second thing would be is that my heirs would get it at $10 a share, and if they sell it, they would have to basically pay that $90. And that would be a big thing. That would impact people at all income levels. So that's a very big thing. And then it reduced the estate tax limitation to $3.5 million from the 11.5 that we're at right now. So there's some things that are out there. Now, again, once I understand the rules, I can work around it. I mean, I can make this stuff happen. All I need to do is understand it. The reason why I'm getting this information out is I want you to have the ability to think about these things right now, because I may be coming back to you in late November or early December and saying we need to be thinking about this. And I don't want to give you a limited period of time to make a decision, a big financial decision, with at least not giving you a heads up. So these are some of the possible changes that are happening. So again, and ending with this, I want to just kind of give you a summary checklist. Again, understand your tax brackets. Again, what is the benefit of me getting income or reducing income in this bracket? Itemizing my deduction. What is the timing of this thing? Let's do it strategically. Gain loss harvesting. Does it make sense to take a gain today? Does it make sense for me to sell a loss today to offset some of these things? What can I do to make it as neutral as possible? Retirement planning, maxing out my retirement account at work if it's at all possible. Education planning, charitable contributions, all these different things are things that we need to be taking a look at really within the next couple of months and seeing what we can do to be very proactive in this area. Now, again, last, I think it's very important for 2020, we got to be proactive. Again, I know what the rules are now. I don't know what the rules are next year. It may make sense for us to do things right now and have an impact on your tax return right now than to wait until 2021 when we're very, very limited in terms of what our options are. I want to make sure that all of you received a newsletter. Again, and I make sure all of you got your JFL masks. There you go. And you're wearing them and you're staying safe. Again, our goal here is to do whatever we can to make sure you pay the least amount of tax that you physically can. I want to be as proactive as possible to make sure that this is working for you, and we're doing everything we can on our side to make sure that happens for you. Again, thank you very much for your time today. Correction is, oh yeah, was there anything else we needed to, oh yeah, and also one last thing. Send us the pictures of you wearing your mask. We want to put them on our newsletter. We want to make sure everybody's getting out and wearing these things. But again, thank you very much for your time. I appreciate it. Call me if you have any questions.
Thanks, Jerry. Now, we realize that this presentation contained a lot of information to digest about potential tax reduction opportunities. We encourage you to reach out to us with any questions. And please note that this presentation is a discussion starting point and should not be used as a substitute for consulting a tax professional. So thanks everyone for joining us, and stay safe.